Hey everybody, happy Friday to you. Time for condors, calendars, and butterflies. My name is Brent Moores, and this week I want to tackle kind of a different, we're doing a series of just kind of approaching different strategies. And we've done condors and variations of condors and calendars and variations of calendars and butterflies and variations of butterflies. Today we're going to kind of tweak that calendar spread into different expirations and do a diagonal spread. So we're going to do that in just a little bit. I'm joined by James Boyd in the chat. Appreciate James always helping me out here. And you can follow either of us on X at Brent Moore CS, at James Boyd CS. We post additional content throughout the week that's related to the financial markets. So check it out. Hey, I see some familiar names in the chat. Glad to have you here too. Appreciate you guys. And before we get too far into this, let me just remind you that options do carry a high level of risk and are not suitable for all investors. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The paper money software application is provided for educational purposes only. And paper money does not assign short options early. Let's see what else we got. All investing involves risk, including loss of principal. I'm not going to factor in commissions in any trades that we do here. Just realize that's a thing you got to consider. And there's no guarantee of an execution of a stop order that is going to be at or near the stop price. Past performance is no guarantee of future results. And Schwab does not recommend the use of technical analysis as a sole means of investment research. There we go. Let's head on over to the Thinkorswim platform. Bring up the S&P 500. There we go. Hey, that's what it looks like. And you can see implied volatilities have actually dropped on. This is the implied volatility on the SPX, by the way, which isn't exactly the same thing as the VIX, but they're going to be pretty correlated there on that. So implied volatilities have dropped. And you know, I get different requests for different topics to talk about, different things to talk about. And sometimes they could be a whole webcast, and sometimes they're just a little bit of a webcast. And, you know, so I'm going to try and address a couple of those today. And in future weeks, I'll try and address others too, other questions as well. But what I wanted to do is I wanted to start off because I had this request on CrowdStrike the other day. And the question was, hey, I'm looking at CrowdStrike. I'm thinking of an iron condor. And when I saw it, I said, well, hey, that makes sense for an iron condor, right? Because iron condors, as we've discussed in this webcast, are more of a neutral-ish type trade. And it looks kind of neutral. But sometimes you may look at it, you may go, well, maybe it's not, maybe I have a little directional bias on it, okay? Also, you know, something to consider when you're looking at iron condors is what's your vega on an iron condor? Your vega is negative on iron condor. You want implied volatilities to go down. But if you're looking at a chart on something like, say, CrowdStrike, so we've got CrowdStrike here, and you look at the implied volatility is basically as low as it's been over the past 6 months, okay? After earnings, we just had earnings not that long ago, implied volatility has dropped. And you can see last time we had earnings, implied volatilities dropped, not a surprise. And it doesn't mean they instantly go way up, but you'd probably expect it to kind of gradually work its way up perhaps, okay? So if you're selling, that can be problematic. And Chris pointed that out in the chat. That's one of the challenges there. So here's, you know, so there's other choices. We can go to a calendar spread. And often a diagonal spread, I consider a diagonal spread to be similar to a calendar spread. But one difference is this, is we can change the probabilities with the diagonal spread. We can make them a higher probability trade, typically. I mean, you know, depends on the strikes you do. We can also make it a little bit more directional, if we like. So I'm going to switch this up here. We're going to look at this trade, but I'm not actually going to do an iron condor, although I think it was a great idea actually. But I just want to look at this chart here for a sec. And let's just talk about it from a technical standpoint for a sec, because very often when we're considering these various options trades, we start with technical analysis. You don't have to, there's more than one way to analyze things. That's one of our disclosures at the beginning. Hey, Schwab does not recommend technical analysis as the sole means of investment research. But in this case, what I'm going to say is this. I'm going to say, if you have a directional approach on this, and you can see we had, we're down a couple percent today or more. We had a high, we had a low, we've kind of had a lower high. We've kind of been maybe going down a little bit, pretty neutral-ish, maybe a little bearish. Our moving average we're down below both our 20 and our 50-day moving average. We just had a 20-50 moving average crossover. Some of you care about that and some of you don't, right? There's a whole bunch of different technical approaches you can take. But the difference here when we talk about a calendar spread and a diagonal is a diagonal spread, we're going to add a little bit of a directional component to it. However, not so much that it's a substitute for, say, a long call or long put. If I'm very bearish on something, I'm just going to buy a put, or I'd consider it. I'm not going to necessarily, but you're going to consider buying a put. If you're very bullish, certainly a long call may make sense. But if you're kind of neutral, kind of bullish, maybe you do a diagonal spread. If you're kind of neutral, kind of bearish, you may do a diagonal spread. I'm going to take a more bearish approach on this one, but just realize that you can tweak these a little bit more bullish or a little bit more bearish. For our purposes, let's just do an example here. Okay, so I'm going to go to the trade tab. I have CrowdStrike up here, and I'm going to give you kind of a generic type diagonal spread, and then we're going to modify them with a couple other examples as well. But what I'm going to do is this. I'm going to go out and I'm going to sell roughly a month out. Okay, so I'm going to go out to the monthly contract. Now, I can go out to different ones, but what I found was on these, a lot of times those spreads are a little bit wider here on these. On the weeklies, we'll see here. Let me look at the 505. That's about $1.50. Oh, there's no 505. A little tighter here, not spectacularly tight spreads, but close enough for what we're doing here. And what I'm going to do is I'm going to go and I'm going to pull up a delta and just understand when I start looking at these things and I start giving you, this is how we're doing it in this webcast. These aren't absolute hard and fast rules. They're guidelines I'm going to start you out with, and then we can tweak them. Okay. In fact, I'm going to tweak some later. But we'll look at some of these here in a sec. But the guideline I'm going to kind of start out with is looking at delta, which tells us how much the option is going to move in relationship to a $1 move in the stock price. But we're also going to use it to try and identify kind of how out of the money something is or how in the money something is. And what I'm going to do here is I'm going to go to about the 30 delta, 29 delta. We'll call that close enough. I'm going to sell that. There we go. Okay, that's all I'm going to do right now. Now, I'm going to go out farther, somewhere a little bit over 50 days, 50 to 70 days, somewhere in there. We'll go to 70 days. And I'm going to buy a contract. I just sold a contract. Now I'm going to buy a contract, and I'm going to buy one that's in the money. I'm going to hold down my control key. I'm going to click on the ask price. And I now have a diagonal spread. Okay. So that's just basic. That's basically how that is. Now, I'm going to analyze this trade. We're going to look at this trade on the Analyze. Well, we're on the Analyze tab. Here we go. And let me just make sure I got my dates right. I want to go to January 17th. That works. This is today's date. Today is the 12th. That makes sense. and I'm going to set my slices to break even on this trade. Here's my slices. And notice, in terms of a few things I mentioned. One, it's more directional. Well, you can see that. You can see that right here. Instead of a calendar, which looks kind of like this on our risk profile graph, that's supposed to be kind of symmetrical, actually. I didn't draw that very well, did I? But you can see this is pretty skewed to one side, pretty skewed to the bearish side. Now, if I were to reverse this right now and do calls instead of puts and do the sell the out of the money call and buy the in the money call, then it would kind of look like this. It'd be bullish, but it doesn't. We did puts. We took a more bearish approach on this. That's one thing I want to point out is we've made it directional with that. What about the probabilities here? Look, this is about a 55-45 probability. So we'll call it a high probability trade, not by a ton, but close enough, we'll say. Now, I just want to compare this right now to if we did a calendar spread. If I did a calendar, and a calendar just means same strikes on these. So I'm just going to make this 500 and 500, kind of split the difference between those two. 500, 500. Here's my calendar. And let me set my slices. Hold on. Let me set my slices to break even on this one. Break even, set slices. Yeah, now we're talking about a lower probability trade. So that's one of the advantages of this. This calendar, if we did a calendar, about a 41, 42% probability of profit. Okay. So one of the questions we had was, how can we find out that I've had and where do I get the questions? The questions, I think this question came from a survey. You know, we give out surveys occasionally in these classes, not every time. I don't know whether there'll be one today or not. They're kind of random. But then you guys can respond and you can ask questions. And one of the questions was, hey, can you discuss the probability of profit? Well, that's what we're doing right now. I'm answering your question. This is how you can do probability of profit. And this makes it very easy, this risk profile tool. And so, I mean, there's other ways to do it, but for these complex trades, which we're doing, this is really the easiest way to do it, okay? Just a quick comment on this. Number one, in the bottom right, have your date be today's date, okay? Have your date be today's date, all right? Number two, in the upper right, go to your expiration date. In this case, I have a couple expiration dates. Chris says, well, let's do this, okay? Go to your expiration date and go one day past that up there. So we got these two dates, do that, okay? That's the first start. That's the first part. Second part is make sure you got your data here correct and make sure it's unlocked. Sometimes this gets locked. And then you can set your slices to break even if you want. You do that right on the menu right here. You can set your slices to break even. And then you can look at your percentages, okay? And in this case, I have 2 break-even points. So that's how you can determine probability of profit. That's one of the advantages of a diagonal. So I kind of mentioned 2 diagonal advantages, perhaps. One is, well, I don't know if one is probability of profit. One is, it may be an advantage, maybe not an advantage, is directionality if you want to incorporate some directionality. But there's no free lunches, right? To get the higher probability of profit, we're sacrificing something. We're sacrificing reward to risk, and that's something Chris pointed out in the chat. Notice, what's my max gain on this? My max gain is a little bit over $1,000. My max loss is coming in under $1,000, okay? The debit, $900 on that is our max loss. Notice what happens when we change this back, let me go back to, let's see, I bought the 520. Let's change this back. I sold the 480. Let me go, clicked on the wrong thing. Let me go again, set my slices to break even, okay? And now, when we look at this, you can see, well, my debit is going to be a lot more. My debit is my theoretical max loss on that, okay? On these debit spreads, my debit is my theoretical max loss. My max gain, I mean, technically it's right up here, but the percentage, the rewards, the risk to reward is not as good on this diagonal. So it's clear. I want you to be aware of pros and cons. That's what we have right there, okay? Is it worth it to you? I don't know. That's going to be one way to consider it. If it starts, this is a bearish trade. If this starts to go up, I'm going to want to get out at some point. Well, what point? Well, that's where we can use our technicals on this. I could say, look, I think that we're going to have some resistance around there. I think it's going to, or maybe a little bit lower. I drew that a little high. But if we go up there, okay, hopefully we have, sorry, that's not a very good line either. But hopefully we get some resistance around there if it bounces back up. Seems to be bouncing down right now. But if it bounces up, I'm going to say that's where I'm looking for the bounce. And at some point, we'll say around 527, we'll get out of this trade. So that's how we're going to do it. Okay, that's how we're going to do it. So, so let me just write that down so I don't forget real quick here. 527. We're going to put in a trade, an exit out at that point. That's not the only exit we're going to do. We're going to get out if we get, you know, close to expiration, within 10 days till expiration, a week till expiration, something like that. Now, can I flip it to show calls? Now, look what happens. If I actually just flip this, I don't want to go to trade. Let me do this. Let me go to Analyze tab. Now, if I just do calls here, it doesn't look that different. But if I switch the 580, what's in the money and what's out of the money, Harry? This is a question in the chat. If I switch what's in the money and out of the money, then you're going to see the change here. 520. There you go. You see how that turns that bullish? There. That's what I was talking about on that. If you just switch calls and puts, though, it's not going to be that different. But why do we do puts in this case? Well, we're trying to keep that put out of the money. We're trying to keep the short option out of the money. I don't want to, you know, there's always the chance of early assignment, even if it's out of the money technically, but the odds go way, way up if it's in the money there, okay? So there we go. Now let's do this. I'm going to put in an exit order on this. And one reason I'll show you why we're going to do an exit order. I'm just going to make this first trigger sequence. I'm going to create an opposite order here on this. I'm going to make this a market order. I'm going to make this a good till canceled order. I'm going to click on my gear. And I'm going to say I'm going to get out if CrowdStrike marks greater than or equal to 527. Okay, so 527, save. I'm going to confirm and send. Make sure you read through this and make sure you're okay with this. This doesn't show my max loss, but my theoretical max loss on this is my initial debit. Okay, so that's like $2,500 there. Okay, so hopefully we go nowhere near the max loss. One reason we put in that sell order, that exit order, is to get out and try to, in case things go scawampus on us. In fact, we had a trade. It was, I think, last week. We'll look at some of last week's trades in a minute. well, in a few minutes, but we didn't have that exit on it, and that has gone south on us. The ones we had exits on have been going fine. The one we didn't put that exit on, well, it's gotten kind of out of hand on this. There. That's why we put that exit in. And that was CrowdStrike. And that has not filled yet. If I wanted to push that a little bit to get it to fill, I can cancel and replace that order. And I can say, well, we're off that mid price. There we go. Let me go this. This should probably get us filled there on this. And I'm going to put that in our diagonals bucket there. So by the way, yeah, and that filled. By the way, when we do these, a lot of times, a lot of these trade management things I do on Tuesdays, on Wednesdays, managing an options portfolio webcast. So, you can check that out. We do further management on that here. Okay, so here's what I want to do. We're going to do another trade here in just a minute, but let me just kind of give you some basics here on this. The diagonal spread. We're going to do one long option, one short option. Okay. Different expirations. Different strikes. The difference between a diagonal and a calendar is this. Calendars have the same strike. Okay. The difference between this and just a vertical spread is this, different expirations on that. So we're kind of combining a calendar and a vertical spread. Now, technically, it would be a diagonal spread it doesn't matter which contract we sell, which one we buy, but what the guidelines we're going to use, and the far more common approach to do this, is we're going to sell the near expiration. Okay, we're going to sell the near expiration, and we're going to buy long dated expiration. Okay, so you could do it opposite, but we're not going to. Not for our purposes here. Number 3, these are positive theta trades. Okay, great, positive theta. These are positive. I don't know why that, usually that gives me, auto numbers it for me. It's a positive Vega trade. We talked about that. Okay, ideally we get in when the Vega's low, when implied volatilities are low. It's going to make it a little cheaper to get in if you do that. And if the implied volatility ramps up, that should help us with that. Okay, so those are those things. What strikes are we going to pick? And again, this is just kind of a guideline we're going to use in this class. We're going to sell 30-ish delta. We're going to buy we're going to buy in the money, ITM, in the money. We're going to sell, and by the way, that 30-ish, let me change that. I'm going to say 20 to 40 delta, okay? We're going to sell probably oh my goodness, I'm not typing around. Sell in terms of days till expiration, about a month, very ish there. We're going to buy 50 plus days. We can change this. In fact, I want to give you an example here of one where we completely violate some of these guidelines that we're going to use, just to show you, because I had another comment. Hey, show me something where you're not, a lot of times in these strategies, we're doing like a month out on these. Show me something shorter term. We're going to do that in just a minute. Let me just get through these get through these. Okay, you can roll if near strike. Let me think. Well, let me reword that. We can roll or close less than 10 days to expiration. That would be for the short contract. Okay, obviously, for the one that expires sooner. We can exit 25 to 50% max gain. We can, this is a positive theta trade, so time can help us out as we hold on to it, but we are going to exit 10 days before expiration, and we're also going to exit on technical breakdown. That's why we put that last exit there on that trade above, I can't remember the price, 525 or whatever. And finally, for money management, we're going to say 1 to 2% of active trading portfolio at risk. Okay, so those are just some guidelines there. Let me just zoom this in just a little bit so it all fits on one page there in case somebody wanted to do a screenshot or something like that. But now, I'm going to actually tweak some of these, okay? I'm going to go shorter term. Most of these are still going to be valid. We're still going to do this and this and this and this, but let's look at some variations on this. Because what you're going to see is it's going to look pretty similar. This is a very versatile strategy as we look at these. And so I'm going to give you more of a bullish example here. I'm going to say that we're turning around here on Dow, okay? Dow, we have a low, kind of established this low. Maybe this was another low down here that was about equal. But we've subsequently bounced off our moving averages, higher low, nice bounce off, little sell-off today, down about 2% today. But looks like, you know, could this possibly be starting a new flag? Possibly. I'm going to say this isn't screaming bullish, or else maybe we look at a long call, but this is more bullish than neutral, I would say. So I'm going to look at a diagonal, a long call diagonal. So let's do that on this. But in this case, what I'm going to say is I'm going to look for this kind of shorter term bounce up here. I'm going to call this as kind of, hopefully kind of a support level. It's actually gotten worse on me since I looked at this earlier today. We're going to look for this bounce here on this. And we'll look to get out if it doesn't go our way. But if I want to turn this into a short-term trade, I can do so. I'm going to go to trade. And I'm going to sell out 7 days. Now, one of the rules I talked about before was exit when you get less than 10 days to go to expiration. We can't do that in this case. We're going to exit when we get to 2 or 3 days before expiration. Okay, we're not going to let this expire probably, but we're doing this very short term. So that one rule, we're going to change on this. I'm going to go out and I'm going to sell December 19th expiration. I'm going to go out of the money. I'm going to go to the calls. I'm going to go to my delta, somewhere around a 30-ish delta. So we're going to sell that 25 call. Click on it. I'm then going to go look to buy. I'm going to go in the money a little bit. And I'm going to, oops, not on December though. We're going to go a different expiration. We're going to go out a little bit farther. We'll go out 21 days. Normally we're selling out 21 days. I'm going to buy this because we're just going short term on this. And I'm going to go in the money a little bit. We'll go to that. Hold down my control key. Now what I want you to do is I want you to look at what we have here. When I click on, I'm going to analyze this trade. Do you see what it looks like? Looks kind of the same. That's what a diagonal looks like. And if we were to do the same thing and say, hey, I want to set my slices to break even. We do this. Roughly 50-50 trade. Probably, I'm not going to bring up a calendar right now, but probably higher probability than the calendar, I would think. It's directional. It's bullish. Are we directional? Are we kind of bullish on this? Yes, we're directional. We're kind of bullish on this. And how much are we risking? We're risking about $106, not factoring commissions here, per contract. We can do more than one contract, of course. We can ramp that up here, and that's going to just kind of multiply that 105 max loss times the number of contracts. But you can see if things go up, it goes great. It's best right here. It gets not quite as good if it goes up, but really we're open-ended on this side of things here. If I don't like this, if I want to shift this down and say, here's where, well, that's our break even. That's, let me go back and do this. Let me just add a slice. There's the current price of the stock right here, okay? If I want to shift this whole thing, I can just shift the strikes a little bit, can't I? There's a great question in the chat, okay? This is from David. David says, is it worth going out further to buy more time so that you can roll more? Well, that's a perfect question. This one, as I mentioned, is intentionally very short term. If I go out, though, and buy something, say, kind of using the guidelines we mentioned before, 50 plus days, or we'll say 50 to 70 days, and I sell something that's out, 20 days or 20 to 30 days or something like that, then what that enables you to do is it enables you to roll this one. When we get close to expiration on the one that's about to expire, when this gets close to expiration, we can then roll this to something that's, in between this expiration and this expiration. On this one, the answer is you can't do it because I just made it such a short-term trade. So not on this one, but on a lot of these you can. There's a consequence. Look, I could roll this, I can go way out on this. I can go 100 days on this instead of the 50 to 70 days. And then I have the potential for a lot of rolls. What's the downside of that, though? That's the upside. That's great, being able to roll it a lot. But the downside is this. The downside is it's going to cost you a lot more because that long contract, that's the debit. This is the debit contract. This is the one that drives how expensive it's going to be. We're keeping the same kind of smaller credit. We're driving up the debit if we go out longer. And remember that debit represents the max loss. So you're bringing more risk into the equation in that case. All right. So I don't know. I don't know which you want to do. We'll look at an example there where we can do that in a minute, but not this example. Okay. This example is just to show you that the basic guts of the diagonal are the same, whether we're going longer term or shorter term, whether you're taking these rules, these kind of guidelines that we take in this class and fulfilling them to the T, or whether we're tweaking them a little bit. Once you understand the basics, you can do what you want on that. All right. So, what I'm going to do is I'm going to say, well, I want to get out if this breaks down on me. Okay. I'm going to get out if this breaks down, say below 23.5 or something like that. So let me go to trade tab. This was our original trade. I'm going to do the same thing. Okay. I'm going to go here. In this case, we're going to create an opposite order. It's canceled. and we said we're going to get out if Dow marks less than or equal to 23.5. 23.5. Enter, save, and I'm just going to move this up off of the mid price just to get a fill on that. Confirm and send, we're going to throw this in our diagonals category. Okay. So Chris says, what's the downsides of doing this short strategy, this short term? Well, one thing is this. When you're deciding on the time frame you're doing, if you're doing using technical analysis, which I assume a lot of us are doing, even though there's more than one way to do it, that's kind of a foundational thing that we do here. One of the downsides is we're trying to speculate on shorter term price movements. I'm basically banking on this flag pattern to develop and us to bounce right here. If I go longer term, it gives me more time to get more wiggle room here for the noise to work out. It's also cheaper, right? This is a cheaper trade. I'm risking less if I go shorter term. Another thing, as you get close to expiration, you tend to get bigger moves in those option contracts. Your gamma drives up on those contracts. And as your gamma drives up, you can get more wild swings on that. So it's just more of a short-term speculation. It's not the standard that we do in this webcast, because I kind of, for most of these trades, I'm not banking on this, this quick move. For most of the trades we do in this webcast, not just today, but throughout the weeks, we're trying to maximize and take advantage of theta and time decay. And that just means you got to let it roast in the oven, so to speak. You got to let it sit for a while. And so we're emphasizing short-term price speculation over time decay in that case. All right. So I would say that's probably, at least at first glance, that's what I would say is the downside on that. It's a good question though, Chris. Let's look at another one. Okay. And this is one I'm not gonna do short term on. Okay. We're gonna go CMG, and I'm gonna go bullish again on this. The trend was down, but what do we have here? We have, it kind of went, it was certainly going down. We had the 50-day is in blue. That's the 50-day moving average. We're just kind of barely breaking above that, but our 20-day was going down, and that's actually been going up now. We have lows. We've established a higher low at this point, okay? And kind of higher high, breaking out. So I'm going to call that bullish here on this. I'm also going to say this while we're here, I haven't pointed out earnings, but just be aware of earnings. It doesn't mean earnings means we can't do them, but just be aware of when earnings are going to come. Our IV is pretty low on this right now. I would expect, I may be wrong, that IVs are going to ramp up before earnings. Why? Because they usually do. This is as low of IV as we've had on this. I would expect the IV to help us out. Now, if I do a bullish trade and the stock goes down, it probably doesn't matter how much the IV goes up. We're probably not going to be doing very well on this. But this can make the difference between an okay trade and a pretty good trade, or a bad trade and something that's not quite so bad. So this can make more of a subtle difference there on that. But for our purposes here, what I'm going to do is I'm going to go out to the trade tab. We're going bullish on this. I'm going to go out about 20 days. This is kind of a time frame that I'm often use, about 20 to 30 days for the short contract. We're going to look to sell that. I'm going to go at the money, which is about a 30, excuse me, I'm not going at the money. I'm going out of the money. I'm going about a 30 delta on this. Let's see what we got here. Well, we'll call that good. 38. Okay, that's a 27 delta. And so I'm going to sell that one. I'm going to go out farther in time. And look, if we sell this January 2nd, and if I were to buy the January 9th, that gives me no possibility for a roll, right? And then there could be, even if we go to January 16th, maybe a roll, maybe not. But if we go out farther, this is to, I forgot whose point it was earlier about doing rolls. This would be a kind of prime category. If I go out to 70 days on this, to February 20th, and I'm going to go in the money a little bit, we'll go delta 62, that's good enough. And I'm going to buy this. It's going to be a more expensive trade. That's the downside. By having the wider the gap in expiration dates between your short contract, I'm going to hold down my control key, and your long contract, that means the short contract is bringing in less money. The long contract costs you more. The ultimate debit is going to be more expensive on this. Okay? So ultimately, that's kind of what we're looking at. If I were to analyze this trade, I'm going to run out of time here quick, so let me do this real quick. I'm not going to spend as long. Looks the same, doesn't it? Do you see the similarity between all these? Okay. So let me go back here. If I want to exit this, I can do the whole technical exit thing if I want. I can also just exit based on the price of it. Create an opposite order. And I'm paying $322 up front. Look, I could say if this gets down to $2, I'm going to get out of this thing. Okay. That's if it goes south on me. And I'm going to make this a stop. Okay. And I'm going to make this good till canceled. Okay. Stops don't guarantee that we're going to get out exactly at that price. Okay? They don't guarantee we're going to get out exactly at that price. Just be aware of that. And I'm going to do 2 contracts of this. Okay. I'm going to confirm and send. I'm going to confirm and send. I'm going to put this in my diagonals bucket. And then as we manage these over the weeks, what we'll do is we'll consider doing rolls. Now, in the last couple of minutes, I just want to revisit a couple trades that we had from last week or a couple weeks ago, perhaps, on some of these. We did some front ratio spreads and some back ratio spreads. I already mentioned Google, how this was kind of getting out of hand here. This was a back ratio spread. I didn't put an exit on this. If I go to analyze and look at Alphabet here, Google, and I see this is where the stock is, and you can see what's happened. We were bullish on this, and we got in looking for the bounce, and it's kind of gone down. It's drifted down on us. So it's going south on us. It can certainly get a lot worse. I mean, it can get down to almost $3,000 of loss on this thing. I don't want to let it get that far. I'm just going to cut my losses here because it's not really looking that bullish. Now, if you wanted to, if you were following along and don't want to get out now, one thing you can consider is you could say, I'm going to put in a stop at this point to get out. Give it one more chance to go up. But at this point, it doesn't look like it's going anywhere quick. I'm going to try and cut our losses here. It's painful. Don't love doing it. But I'm going to look to get out of these contracts. So I'm just going to get out of this. And I will do that. And I didn't get out of the whole thing at once. Come on. I didn't get out of the whole thing at once. I'm getting out in 2 separate transactions. Just once you get more than 2 legs, 2 different legs there, sometimes it's hard to get out in one transaction there. So we're going to get out of that. Our other 2 trades, just as we're wrapping up here, that was a back ratio spread. We have an NVIDIA front ratio spread, which is doing fine. We only have 7 days to go, so we're going to get out of that. The Netflix back ratio, we've got 21 days to go. It's going pretty well. I'm going to stick with that one. We also have an exit on there, but I'm going to look to exit in NVIDIA here, just because we only have 7 days to go to expiration. It's not going to make up for the loss we took on the Google, on the Alphabet trade, but it'll help a little bit, help lessen the sting perhaps a little bit there. So I'm going to look to get out of that. All right, everybody. Hey, I'm out of time. Thank you for joining me, everybody. And coming up next, we've got market and sector analysis. Thanks, James, for helping me on the chat. And everybody, we're going to see you all same time next week. Bye-bye.